Jeremy, thank you very much indeed for joining us. Well, you know, we are at the moment seeing very strong similarities with 2008. And how does 2011, 2012 resonate with that?
I think there's a lot of similarity, though in some ways we feel better prepared. But the real challenge is how we're going to fix some of these issues. And I think the whole question of financial stability is at the front. And 2011, I think, marks the period from thinking about what we might do to actually taking the action. And if you look at the announcements... Sorry.
Please carry on. I was just going to ask you, well, you know, are you confident that the noises coming out at the moment are the right ones? That's what I want to get to.
The question is, how do you balance stability and growth? If you look in Europe, 1 to 2 trillion euros of risk-weighted assets coming off balance sheets, that's got to make for safer banks. What's it going to do to the economy in the short term? And that balance between short and medium term is really what banks and regulators have got to get to grips with.
Of course, Basel III is one of the requirements here as well. So, you know, you say the short term, perhaps the medium term here. What sort of time frame are we really looking at is one part of my question. The other thing is, well, how are banks actually coping with this as well? And how are they shoring up their balance sheets? And is it coming at the expense of what?
Well, I think that we are definitely starting to see business models change. And most banks are dealing with it by reducing their risk-weighted assets rather than going out for more capital. But I think the real challenge here is liquidity, because the capital piece is what everybody talks about, but liquidity in the is what is really hitting the bottom line of banks. And if they can't find the medium-term liquidity they need for the new liquidity rules, that is going to be a real constraint on business, and that will feed through to the amount of credit in the economy and the price of that credit.
Which again then turns around and feeds itself. It becomes a circular argument, doesn't it?
If you just take Italy, with the government funding at 150 basis points more than it did 12 months ago, that feeds through to the banks, that feeds through to the price that businesses are paying for their working capital, and as you say, it is bound to hit the economy itself.
What does this all mean, actually, for return on equity when we look at banks?
I think that is where the big debate is. If you talk to the regulators, I think people are expecting to see that return on equity will only just get into double digits. I think we have lots of banks still looking at how can they get back to 15, 16%. But I think most people are expecting that return on equity will be, let's say, 10 to 11%, rather than the 14% plus that people have aspired to.
And what people have gotten used to as well. I guess, you know, Basel III, and that's what the banks are really aiming for here, they've been given a lot of time to, you know, make the necessary adjustments, but they're having to do it with, well, alarming rapidity, aren't they, Jeremy? And does that worry you?
I don't think it does worry me, because I think that on the capital side, actually that brings confidence to the system, and every bank I know expects to be able to meet the requirements by 2013. And that is driven by the market demand as opposed to by the regulators. So banks say, we won't aim for 2018, we'll aim for 2013. But I would come back to the liquidity piece, which I think is where banks are going to really struggle to meet those market demands for liquidity in 2013, and more time is required to meet the liquidity needs.
Jeremy, thank you so much for joining us. Jeremy